I'm Ishreth Hassen, Head of Research and one of the multi-counselor portfolio managers of the Foord Global Equity Fund in Singapore. In yet another eventful quarter, the Global Equity Fund outperformed, rising 12.2% versus the MSCI All Country World benchmark, which rose 9.9%. As many of you know, we like to buy and own businesses that are priced at fractions of their true worth. This approach typically works well in bear markets where stock selection and portfolio construction shine, as it did over the past year. In 2022, the fund declined 13.1% versus a benchmark that fell almost 18%, generating an outperformance of 4.8% for the full year. We're always pleased when we outperform, but it's extra special in a down market amid a whole host of concerns and risks, including a prolonged war in Europe, COVID-0 in China, supply chain constraints globally, a hawkish Fed, and an imminent US recession. 2022 was the worst year for stocks since 2008 and the worst year for bonds in multiple decades, with both asset classes posting annual declines for the first time since the 1960s. A bright spot for markets and our portfolios was the rapid reversal of China's COVID-0 policy, which was always a question of when rather than if in our minds. Over the past year and a half, we've managed to buy some fantastic businesses in China at really fractions of what they're worth due to a perfect storm of misplaced policy, a macro slowdown, and a gross misunderstanding of the intent behind Chinese policymaking. Today, these factors are moving in the opposite direction as China's focus on high-quality growth and development become evident in the only numbers that truly matter: earnings. The businesses we own are priced at ridiculously cheap valuation levels on very depressed earnings expectations, no matter how you slice it. As China reopens, we believe the quality of these businesses will become evident in their tremendous earnings leverage, leading to further outperformance independent of the global macro environment. In the fourth quarter, our biggest performance contributors were China's largest online travel agent Trip.com and luxury brand Moncler, which rose 31% and 27% respectively. Both businesses are beneficiaries of a return in Chinese travel, which is an inevitable structural trend. We have also been underweight US tech for a while, which further contributed to performance. We look forward to scooping up more bargains in this volatile market, especially in high-quality US businesses that were too expensive previously, but are now becoming a lot more reasonable by our standards of value.